Hey, on to round two. Let's see how we did this round. So, first, let's take a step back and take a look at that first assignment and talk about that. Uh, Please pay attention. The exact questions certainly won't repeat themselves as we go through the game, but there may be similar questions. I mean, the questions may be somewhat exact, but obviously the dynamics of the game will have changed, what the answers are going to be and whatnot. And so please pay attention as I go through these. And it'll hopefully also, I mean, it's my desire, one, that you start to understand the things that I like to look for, and I think lots of people like to look for in financial statements and whatnot, and also give you the idea of how deep and where you need to look and those types of things when you're looking at the Capstone Courier. And that's probably where 99.9% of the questions will come from this semester, is from that Capstone Courier, and how you need to start piecing some of this stuff together. Lastly, I think when you learn to answer some of these questions, it'll make you play the game better. It'll allow you to be able to play the game better when you really start digging deep and looking at the financials. And from real experience, I can tell you that knowing and understanding the financials of any business is vital to making decisions about that business going forward. It's crucial. What other words, synonyms of those can I give you to let you know, just how important that is? Yeah, we can get by doing business a little bit intuitively, but digging into and understanding the financials become of the utmost importance. So here we go. From round one, practice round one, I asked this question: what effect did issuing stock have on Chester's earnings per share? I have a similar question, by the way, for round two. Please provide a numeric answer. A, it lowered the earnings per share. Has to, right? The earnings really didn't change. Okay, by issuing stock has virtually nothing to do with the earnings. At a stretch, you could say that there might be a little interest income or savings. That would be negligible. Okay, so at a stretch, you could say that it added a little bit to earnings, but that's completely, even if there is a negligible impact there, it's completely offset by the fact that having more shares outstanding. It's a simple division problem, right? Earnings divided by number of shares outstanding. Okay, the original shares outstanding were 2 million. Was for every team, right? And Chester earned 8.4 million. Okay, so 8.4 divided by 2 million, the original shares, gives you 421 per share is what they would have earned had they not issued 361,000 shares. Okay, they earned the same amount of money. Okay, that, like I said, wouldn't change. It's hard to imagine any kind of a meaningful impact to the positive in terms of earnings by issuing shares. And in fact, you'd have costs and stuff associated with issuing shares. But anyhow, 8.4 million shares divided by 3.61 gives us $3.56 of earnings per share. Okay, so whatever that is, 44.65 difference there. That their earnings per share actually decreased because of the issuance of stock. Okay, one thing for those of you that have had me in classes before, and a lot of you obviously have been online, but I think one thing I'm very fond of saying is, and keep this in mind as you play the game, debt is cheaper than equity. Okay, debt is always cheaper than equity. How many times, I guess I'll have the rest of this semester that I can remind you of that occasionally. So, why did Andrews have a relatively low contribution margin? Okay, this one might have required a little bit of digging, and probably a little deeper into the game maybe than I should have asked here at the start. But contribution margin, it gives me a chance to really explain contribution margin, and it's such a huge factor in the game, right? Contribution margin is only a component really of two things: price on the one side, variable costs on the other side. Price is price. Okay, you get the various segments, so it's price, in each of the individual segments. Variable cost is a component of material cost, labor cost, and last is carrying costs. Okay, so material cost, labor cost, last is carrying cost. And if you look at, and we can take a look at Andrew's, hang on, I'll bring it up here. If we take a look at Andrew's in the production analysis, this probably gets a little small for you guys to see, but if I scroll down here and we look at the production analysis, if you kind of follow along, if you went down and you look at their material and labor costs compared to the other teams, actually, like in their traditional segment, their material cost was less, labor cost the same. They had a decent contribution margin there. Well, while they had a decent amount of inventory there, it wasn't huge, and same thing in the high, relative to their sales, I guess. But if we come down here, there certainly is, some inventory and some carryover there. Relative to other teams, though, it's maybe similar, especially in the traditional end, right? Okay, but you get down here to the performance and size. Look at that, contribution margin 0. Well, its material costs are the same roughly. Its labor costs are higher. My guess is they produced more. They had second shift 100% overtime. Okay, and so they had some overtime there early on. So that would have partially contributed to it. And if somebody had that in their answer, I'd certainly say that. But nonetheless, that's $25, a little better than 25, $26, and the price was 32. So there still should have been a contribution margin, right? Still should have been $6, divided by 32. $6 profit divided by 32 is 20%, say 18, 20%, that there should have been a contribution margin. But we got 0. Well, it says carrying costs, and they don't show up on here, okay? But they do show up here, right? Variable cost, labor, material, carrying. So if it's not labor and material, and again, those probably contributed somewhat, then you have those carrying costs. And same thing in the size, not quite as much inventory. And that carrying cost would have certainly affected, these two segments as well. Okay, so those are important deals there. Okay, so that one took a little digging, and I apologize for making you dig like that. But a good learning lesson, however. Again, remember how important contribution margin is, okay? And follow along with that. When I look at it, it's one of the first things I look at when I open up the courier for the next round. I want to see how the contribution margin went. So okay, so then I asked 3, how many units of sales did Andrews miss out on in the low end segment? And I think I said an approximation was okay. So I looked at it. You could come down here and you could say, well, let's see, that sure looks like 12, and that looks like 19. So I'm guessing about 7%. There is a better way to look at that, but they missed out on about 7% of the market. And I just asked for units. 7% of 10,000, or that's actually 10 million, but 7% of that would be 700 or 700,000, right? So about 700,000 units. That was a close enough approximation for this. As the semester goes on, I'll probably ask questions that will have you calculating more exact numbers, like how many sales would be the next step, and I might want you to be more precise. If I ask you to be more precise, we would come down to this, and we would say, okay, actual market share in the low end, Andrews had 12.1%. Andrews could have had 19.3%. And that's kind of divided between a couple of deals. This one would have been a little bit complicated to figure out. Not so much on the sales, but maybe a little bit. So they missed out on 7.2% of the market. What gets complicated a little bit is that their acre had a potential of 19.1% of the market, so a big share. And they only sold 9.7% of the market, so they ran low of inventory there big time. They could have picked up, what would that be, 9.4% additional market share. And they actually oversold a little bit with Able. Okay, so we'd had to net some things out when we did that, which is calculations that we'll show maybe a little bit as we go along. So, okay, so that's it for the assignment. Don't be surprised if your grades are if you do when you get your grade. I kind of glanced through. I hadn't graded them yet, but I did glance through what got turned in. It looked a little tough, looked a little rough, okay, which is to kind of be expected as we go along. You'll have plenty of opportunities to make up, okay, that's number one. Number two, by the end of the class I get a little bit more concerned with how much you've learned rather than what those first grades are. Three, I usually drop, a couple of grades, and so, yeah, okay, so I wouldn't fret. Four, the assignments are a part of your grade, your activity, and what were some of the other, your comp exam and some other things make up other parts of your grade. So please don't fret too much if your grade comes in a little lower than what you'd like. Okay, let's jump ahead to round two. Let's take a look at what happened there. It was a good round. I get the every Monday then, or whatever day, Monday morning it is, as long as I remember. It's kind of fun. I get to click on a couple buttons and see how it did, and I sit there in suspense. I hope that you guys start, as you get through understanding the game a little bit better, I hope that you start to enjoy that same level of suspense, kind of. And anticipate the results a little bit, because I do. I like to see how everybody did. So, okay, we look at this, and again, the selected financial statistics, and my first glance is generally at the sales. I just like to see how they did. And Ferris is dominating. Our computer team's dominating. Not unusual for the first couple rounds in the practice rounds. And I might come up, I'll glance at ROS. Yeah, that's pretty cool though. Chester had a 9% return on sales and Ferris 9.2%. So Chester did well. Their ROA, in this game I don't view ROA as being terribly significant. ROE is always significant. Ferris is killing it there. 28% versus 15% roughly for Chester. The rest of the team's down. Of note, every team was profitable. Boom, here's the profit. Super. Okay, every team had a positive ROE, they were profitable, and no team had an emergency loan. So pretty impressive actually getting into the second round, so I was happy to see that. I start to look at some of the reasons, and some of them are right down here. Our contribution margins, we're everybody approaching 30. I see a really good one here. For the second round, 33.5% contribution margin, excellent. Okay, 30% for Ferris, so that's excellent as well. But for the second round, being above 27%, everybody is really pretty impressive. We'll see those expand. Through the practice rounds, we'll see people get into the high 30s, 40s, maybe. Competitive rounds, towards the end of the competitive round 7, 8, we might see some bigger numbers than that, quite a bit bigger than that even. So, just depends on where you guys take it. It depends on the strategies you guys have chosen and those types of things. So, SG&A to sales. Again, I always put these two together and kind of say, this one you want to be big and this one you want to be small. And you'll see here again, Chester had a really good combination there. The highest contribution margin, the lowest SG&A to sales. When I see a low SG&A to sales and yet still, in this case, second best sales, okay, really efficient then. Efficient at making sales without having to spend a lot of money. Okay, that's a big plus. Ferris spending a little bit of money. Other teams, we're getting bunched up a little bit. Chester's impressively on the low side. Andrew's fairly low too, but we're fairly bunched up. The difference between 8% and 11, 3.4%, say. That's significant though. on this amount of sales, on 100 million in sales, you're talking $3 or $4 million to the profit before tax. So pretty decent. And so things to be aware of. Again, what you really want to do, throughout the game is figure out ways to push sales, and at the same time try to increase your margins. Okay, and you'll increase your overall margins by increasing this number and maybe reducing this number. Again, it doesn't necessarily mean you spend less here. I'll bet you, Ferris spent a lot of money here. Okay, but the reason that they're at 10%, which is kind of in the middle of the pack, is because they had 194 million in sales, so they spent effectively there. So for the SG&A, it's not how much or how little you spend to get that number down. It's how effective you are using those dollars. Okay, and that has to do with a lot of other things: your pricing, your positioning, those types of things. Okay. So we get down to the stock market summary, and we see in this case every single team, okay, except the computer team, has issued stock. Okay, every team's issued stock. That's kind of why I asked the question last week. There's a question on this week's assignment that's similar, and I want you guys to take a look at and be thinking about that as a tactic. Okay, teams pretty much went up in price. Digby and Baldwin a little down. Andrews made a huge leap. Remember, they were down to $1. Boom, jumped way up here to 22. So they made a nice comeback. If we'd had a lot of money invested in them at $1, $1,000, we'd have had 1,000 shares. Now that'd be worth $22,000. That'd be sweet. Okay, so we look at that. We look at our earnings per share and kind of what's gone on there. $9 for Ferris, but Chester at $5, pretty good. Dividend, Ferris the only team paying a dividend this month. So I usually glance through the bond market report. I don't spend a ton of time on it, just maybe seeing if teams are borrowing a lot of money. That also is going to show up in the cash flow. Okay, and so I don't spend a ton of time looking at that one. Now I come down and I do hit the cash flow next. So top parts, we talk about the income, and depreciation can be a thing to look at. That shows up obviously then in the income statement too. It's added back in here because it's non-cash expense, right? But a big depreciation number relative to the other teams might mean that we get a team that's investing heavily, and we'll see. Remember, actually Chester invested pretty heavily in round one. It doesn't look like they invested a lot here in round two, at least on a net basis. They didn't invest a lot, so we'll kind of see. Accounts payable, some inventory. And again, this is inventory, how the change in inventory affected cash. This isn't how much inventory you have, and that's the same with your accounts payable. It's how that changed in relation to cash. So, and accounts receivable the same. Those typically I won't spend a ton of time on. Maybe the inventory one we'll come up and look at. In Erie's case, their inventory affected their cash to the tune of about 20 million. So my guess is their inventory went up substantially for Team Erie. Okay, this round, Team Digby did some big time investing. Okay, huge investing. So that's interesting. Almost as much as Team Ferris, in plant improvements. Team Andrews had a net positive there, and I think we might have talked about that last round in regards to was it one of the other teams? Maybe not, but a net positive there means that they actually sold. Okay, they sold capacity or something. In this game, it's pretty much capacity, and generated cash. It doesn't mean they didn't invest. Also, they may have. That takes a little more research, a little more sleuthing to figure that out. But Digby, we know, invested substantially. So, sales of common stock. Chester didn't do any sale of common stock. They did a lot in the first round. Didn't do any this round, so it's kind of interesting. Long-term debt. Okay, we did see some issuance of debt. Remember, Andrews had the big emergency loan, and so they borrowed some money, obviously, to kind of offset that. Okay. And we had some there's a lot of cash sitting there. You know, Erie's got the least amount, and they're still about 10 million, and so there's a lot of cash really between all the teams, and you know, that's okay. It's how that cash gets deployed that's going to be really important. So, decent amount of inventory. You know, Erie's got a lot of inventory. Baldwin, Andrew's got a lot of inventory. Okay, and so Andrew's made a nice comeback, but they still have a lot of inventory. And it's important to recognize that inventory, not just for your own team, but for every team, as you're making those decisions going forward. Plant and equipment. You know, as the game goes on, I like to pay attention to this. Chester is a big company with $136 million of plant. Ferris has only got $94 million, so our computer team has really shrunk, actually, the size of its plant. Okay, and they still invested $12 million, so I'm wondering if that's a net thing. If maybe they invested more in some areas but sold off in others, which might give some indications as to their strategy. Okay. Very possibly, but that's a small company. Think about that, you know, when you talk about asset turnover and some of those other things, which are efficiency ratios, and how important that might be. That, you know, even though, you know, this is a small company with the $94 million in plant that generated 30-40% more in sales than any other team. That's pretty impressive. Okay, total fixed assets then is kind of similar. You know, we take a look at that, and again, Chester's a big company. Chester's a big company when it comes to total assets. Andrew's even bigger. Okay, bigger. Okay, which affects your return on assets, right? Okay, then we come down to debt. You know, accounts payable. That doesn't really change a whole heck of a lot. That's more a reflection on your sales, unless you change that accounts payable policy. Okay, current debt. That can change from round to round big time, and it usually, I usually shrug my shoulders at it unless I see something that's really weird. Long-term debt, of course, can affect the interest and whatnot that you're paying. Again, we see Andrews with a lot of debt, a lot of liabilities, probably making up for the emergency loan that they had the first time, and also still financing a lot of that inventory. You know, if you get $50 million in inventory, you got to do something, you know, to pay for that inventory to finance it. Okay, common stock. Again, we had some issuance, obviously, some of these companies. Retained earnings. Don't pay too much attention to those because it's a little bit, what have you done for me lately? But total equity is a big thing. Okay, would you rather be a big company or a small company? And it's kind of interesting that Andrews has the most assets, but they have the smallest equity. Yeah, interesting. And that's because they got a lot of debt, right? So they got a lot of assets up here. But remember, the inventory is a big part of that. You know, out of this 140 million, you know, take the inventory out of there, they got 90 million, okay, and they're, you know, smaller than a lot of them, okay. So the inventory is a big part of that. So you need to look at these and pay attention to these and figure out maybe what's causing it and why those things might be important. The total equity is a huge thing, and why is that? What's return on equity? Net income over equity. Okay, and so if net income stays the same but equity goes down, what happens to your return on equity? That's a good question. That one will be on future questions. Might even be on this week. Maybe I didn't put it that way, but it's something like that. Okay, then again we get down here to the sales and stuff. I absolutely do not pay any attention to the variable cost dollars. Okay, again, I'm more interested in the margin. Okay, because if I looked at the variable cost dollars, I'd go, oh my God, Ferris has got $135 million in variable costs. That's horrible compared to Baldwin's only got $75 million. You know, geez, Baldwin did a much better job of controlling costs. No, Ferris has had $194 million in sales, and Baldwin only had $106 million. Okay. And so the factor that's important there is the contribution margin, to see how well they're selling, how well they're pushing their products, and then the margin, or what part of that contributes then to the profit. So depreciation, you know, pretty big deal. Remember, we said Ferris had a small plant, you know, 94 million in fixed assets, so their depreciation is actually a little smaller, which is kind of nice. SG&A, and remember I said that here again, while their number was only 10%, which is kind of middle of the pack, look how much more they spend. Okay, they spent way more You know, what's the nearest one? 7 million away? Yeah, they spent $7 million more than any other team, and yet they were kind of in the middle in terms of SG&A to sales. Very effective. Okay, very effective at selling. So one, they're investing in the marketing side of things, which is really important. But two, I bet when we look at it, they're also positioning themselves well. Okay. Other fees, write-offs, usually not much. We'll see this take effect when you guys start doing TQM, because that shows up there, and that'll be round 4, if I remember right. EBIT, earnings before interest and taxes, just kind of what you would expect. Interest, you know, big number still here for Andrews on account of, you know, all the financing and whatnot that they're doing. Right, they've got quite a bit of debt outstanding. My guess is they'll whittle that down. So you got taxes then based on that, profit sharing. There you go. There's your income. Look at that. You know, all of our student-run teams, I would tell you, still have way too much capacity. Way too much capacity. Ferris, on the other hand, look at that. They're fully utilizing their capacity. You know, they've got the capacity to make 3,000 units in the first shift. Add another shift, they can make 6,000 units. They're right there. I mean, they're pushing their capacity. And I won't remind you which team appears to be leading by a substantial margin. Okay, and so while we may worry about paying overtime and those types of things, okay, I'll let you guys worry about that. We come down again. We start. We kind of look at the inventories. I wanted to come down because one of the things I had talked about was it kind of looked like, you know, Ferris, because they were investing money in plant, and yet they had kind of they had a smaller plant than anybody. Well, how did that happen? And I said, you know, look at that. They've invested. They've actually introduced a new product. Looks like they've maybe even bumped up some capacities here. But look what they've done in even the high, low, and traditional ends. They've definitely dropped capacity there. Okay, they've dropped capacity substantially. Okay, and so that's a huge generated some money for them. Okay, it also might give you an idea. Kind of what Ferris' strategy is, where they're going with that strategy. That's important to know. Take a look at that. Okay, so yeah. Okay, we come back. Andrew, same problem. Okay, look at that. Still, you know, they had 1,400 roughly units available for sale in the performance category, which would have represented over 50% of the market if they could have sold it. Okay, and they didn't. They didn't come anywhere close, and you know, trying to get 50% of the market would require a whole lot of stuff. And when we get down to the performance thing, we'll kind of take a look at that. And roughly the same they had in the size, and they sold out though in the traditional and low end. So they did a really good job there, and that's where they made money. Look at that, they had positive contribution margin. You come here, they had a negative contribution margin. Well, again, what do you think that cost, the carrying cost on that? You know, their margin here would have been okay. Look at that, it's about $10, not quite $9. You know, so 30% until you add in the carrying cost on that, and that's what gave them the negative on the contribution margin. Baldwin, a decent amount of inventory here in the traditional and amounts here. Okay, Chester, nice job. You know, little inventory there. You know, 300. That's more than you'd like, but you know, it's not horrible. Okay, Digby, nice job. You know, again, little inventory in 3 of the categories. 4th and 5th ones, not too much at all. So really not bad. Note here too, the low end, everybody sold out. Yep, including Team Ferris. So everybody sold out in the low end again. Erie, huge, okay, huge negative here in the traditional in terms of inventory. So they had about 3,000 units available to sell in the traditional, and that would have represented more than 31, 32, 33% of the market. You know, so they were apparently planning on selling a bunch, and yet my guess is they weren't positioned, nor probably did they spend the kind of money that they would have had to in order to push those kinds of sales. They sold a bunch, you know, they sold, you know, right in the ballpark with some of the other teams. But boy, you know, if you think that you can garner that kind of a market share, you better be positioning your product correctly to do that. So let's look at that traditional, since we're right there, and it was Team Erie that we were looking at with all the inventory. So they were they were the fifth best seller. They must have sold some of their other products in that category too, yeah, a little bit, but they, they sold the fifth most. Decent. They didn't sell out, obviously, because they had all that inventory. So did they position themselves the best? Well, let's take a look. What's the most important criteria is age. Okay, and they wanted to be about 2, but again, here at the end, you'd just as soon be younger than 2 at the end. Okay, meaning that it went through that, and eats at 2.85. So out of the top, however many, that's a bunch. They were the second worst in terms of their age, second only to Baker, which they were pretty darn close actually. Okay, so then you also look at the price, 29 being the max, and well, look at that, Fast sold a bunch and they were at 29, but they were really close in the age. Okay, so that was pretty important, close in the age. Okay, positioning 7.2 on the performance, so in 14. Eat was actually sitting pretty good, okay, in terms of the performance out here, and then on the size a little bigger, than a lot of these, other than Cake, right? Okay, so age, and they didn't spend a ton, same amounts as some of these up there, and again, they sold quite a few. They weren't that far behind Baker, and they weren't even that far behind some of these other ones. It was just their estimate of sales that was completely off. Their MTBF was actually better, quite a bit better, but of course that one's way down here in the bottom. Okay. Revision date, the revision date was fine. I just kind of look at that and see where we're at. A decent December customer survey, so folks are kind of looking forward to getting that. Okay, so a lot of little things is what kept Eat, from selling a bunch there. Okay, with the important one being the age. Okay, let's cruise on down and look at the low end. Everybody sold out of their low end product, and again, they picked up some sales of some of the other ones in here, but everybody sold out of the low end product, and Chester did the best job then, getting stuff in there. Lowest price. Look at that. They dropped their MTBF down to the bottom. Wow. Didn't affect their sales. Strange. Age. Remember this one. Age is a big deal, but they want one that's 7 years old, and your guys' are getting older. Ferris has got the oldest one there. Your guys is 3, but Ferris was priced out of the ballpark. Okay, so they weren't pricing. They might be using this as kind of a cash cow. Okay, they were able to sold out. They had $22. They probably had a really nice contribution margin. Okay, sitting good, and they spent a decent amount here on marketing and stuff. But Chester, that's impressive. They garnered the biggest amount of sales. Had a low MTBF. What's that mean? The low MTBF. Well, let's take a look in the low end for Chester, and which would be their cedar product. Their material cost $583. If you look at Dell, their material cost is $672 and $686. Now, Bead was getting down there kind of, and Acre down to $455. Okay. So part of the material cost is based on MTBF. Acre had they had the lowest material cost. Part of the other material cost is based on age, and I think there's got to be at least another factor in there, and I can't think of it off the top of my head. I'm sorry. Okay, probably be in your guide though. Okay, so interesting. We did meet the demand, but only because we actually sold some other products from some of the other categories. Days sold 7%. Is Days Days is way up here as a it's interesting. So it's a traditional product, but it sold a bunch there. Was it because it's price? Wow, that's kind of interesting. How come Days sold so many there? Days must have had a bunch they must have made a bunch of that traditional product and managed to sell. Oh, heck, they're showing days as being in the low end. That's interesting. It sure doesn't look like it from there. Wow, did it sell more in the low end than it did in the traditional segment? Traditional segment days sold 648 units, and it actually sold 739 units in the low end segment, even though it's quite a ways up here. That's kind of interesting. Huh. It must have been the next best positioned product for other reasons, perhaps. And it might have been price. You know, cake might have sold some. You'd have thought Able, but it stocked out in the traditional, so that was probably the reason. So it might have been just the next most available in terms of price and some of the other factors. Yeah. Sometimes in the limited time that I have to do these videos, I don't figure those out. I get some questions for myself that I have to go back and look up, and rather than take all your time, I'll kind of move along. But when I do those, I'm giving you an idea, I hope, as to things that you ought to look for. Why is that important? Now, gosh, I want to figure out why days sold so many in the low end, even though, you know, it doesn't look like it was really positioned. It looked like a couple of these should have been positioned better to sell in the low end. Maybe they ran out. I don't know. Okay, those are the things that I would certainly want to ask myself and really check into. So, that's interesting. Huh. Okay. Got to cruise on. High-end stats. Okay. 3,600 could have sold. You know, again, the importance things. Look at that. Now, the thing about when I look at the perceptual map here, and I look at the actual versus potential and whatnot here, I mean, there's only one team right now that's really competing in the high end. Okay. It's the second round. I already have a pretty good idea what Ferris's strategy is. Okay, they're pushing things in the front end. I'm also starting to get some pretty good ideas, if I'm analyzing this, what the other team's strategies are. What I would tell you is that already here in the second round, there's tactical opportunities that are really presenting themselves that might be outside of your strategy. Okay, and that would go for all the teams. There are some tactical opportunities here really presenting themselves already early on, just looking at the perceptual map. That if you're aware and if you're looking at it and studying it, you ought to be able to kind of maybe figure out what those tactical opportunities are. So Fist or Ferris's products sold a lot and sold out. Again, in the high end, you know, the Andrews sold a lot, but obviously made a lot more. You know, they garnered 25%, so a good market share. They had a bunch available there, but you know, they still had a lot in inventory if we went back up and looked at that. Sold at a really low price, Andrews did, okay, relative to the competition. Ferris, you know, yeah, shoot, highest price, you know, but look at its age. That's an important thing. You know, they're pushing out the revision dates to the end. You know, Andrews, their product's looking old. You know, they're lucky they sold what they did. You know, it's the next best in terms of positioning on here, but their product is looking a little bit old and tired, okay? And because it didn't revise at all this year. Okay? Age-wise, you know, you look at some of those things. It's really interesting. Again, Ferris is doing some stuff there that's pretty obvious. You come down to the performance, and it's similar. Coat's kind of looks like Coat is leaving the performance segment and maybe going over into the traditional segment. Just going to kind of glance at these. Again, Ferris is dominating. Nobody's really competing against Ferris there. And nobody's competing against Ferris here in the size segment either. Okay? And you can see that just by glancing at those. Okay, huge numbers. Okay, huge numbers. 46%. It is kind of what Andrews was shooting for, but Andrews obviously isn't anywhere as positioned near enough to try to take that kind of a market share. Okay, not anywhere in the ballpark close enough to do that. So at this point in time, okay. Again, we can get some actual numbers down here, actual versus potential. I don't know if I went down that. Did I see huge ones in? Chester had quite a bit more potential there in the high end or performance that they didn't take advantage of. Yeah, some here and there, not a bunch. A little discrepancy here. Ferris had more potential here in the low end that they didn't take advantage of. Baldwin, got the benefit of a lot of that, and fairly even there in the traditional segment. Okay, so then we cruise on down. We take a look at the overall perception map, and this one makes things a little bit clearer to me. Ferris got a new product coming on. We saw that up above. Their strategy's clear. Second round, and if you haven't figured out Ferris's strategy, shame on you. Okay, it's clear. And you can tell that just by looking at the perceptual map. But you could look at the other things that they're doing and compare them to what it tells you in the guides or in the strategy, tutorials and those types of things, and you'll know what they're doing. Okay, figuring out what the other teams are doing, interesting. Okay, the one team here that's really making interesting move with these products is Chester, right? Okay, they got two products here that are basically on the intersections, and see what happens to those products. So okay, this just gives you a nice rundown of where the products are positioned and whatnot, a little easier look at it. HR, I thought year 2 you guys had the ability to do HR. I think so, and nobody did enough, even including the computer team. There was some investing there, but nobody did enough to push this at all, the productivity index. And that's usually what I start looking at. Investments here can increase productivity, which can reduce labor costs. Okay, but your guide tells you that it takes a certain amount of an investment in order to push the numbers up here. Okay, and nobody did enough to really push that. Doesn't mean that it didn't give you some advantages it might have in terms of less separation, less employee costs, different things like that. So you might have gained some advantages from those investments, but I have seen these productivity indexes get reasonably high. Okay, by that I mean double digits. Okay, above the 100%. So yeah, that can be a big deal. TQM you guys will do in round 4. I believe round 3, coming up this round, you guys start making advanced marketing decisions, and that's where you simply you move your marketing dollars around a little bit. Okay, you move them around a little bit inside the product segments and whatnot, and so it moves the bar a little bit. Okay, it can be real helpful. It really fine-tunes some things in terms of your marketing, so pay a little attention to that as we go into this round. So let's take a look then at who won round 2, and then we'll look at the assignment for round 2. Practice round 2. Here we go. Okay, data that we got from the reports. This one's the selected financial statistics, I think, or something. I think you guys have access to this too if you really wanted to. It's got a lot of just data in it then that I'm able to incorporate into here. I don't use all of it by any means. I don't even use a whole bunch of it. It's just easier to copy and paste the whole report and bring it over here, and then I can set up my formulas and whatnot for it. So Ferris did the best. Chester second best in terms of earnings per share. ROE, my second biggest component. Okay, I hope you're paying attention to what I value the most here, and then also in terms of some of the questions that I'm asking you from week to week here. So Ferris, best there. Best contribution margin was Chester. Best stock price increase was Ferris. Best profits, Ferris. Best improvement or best cash flow was Andrews. Andrews did a nice job getting their cash flow back. Strategy. Ferris didn't sweep. Got a 98 for the computer team, a 91 for Chester. Pretty good if we don't have any deductions, and we don't. Andrews had a leverage deduction. They still had a lot of debt. You know, we looked at that when we were looking at their balance sheet up there. Right, they still had a lot of debt. Their leverage was 2.9, I believe. And Digby a little short on the working capital. I think 20 million is my working capital. And they're at 15 million. So working capital, remember, current assets minus current liabilities. So again, you know, not a huge deal, you know, when you fall below that, but it denotes risk, and so I ding the teams a little bit for the risk. So there's your winner. Once again, Chester doesn't have to write reports for this round. So let's take a look at this week's assignment then. Assignment practice round 2. Okay, here we go. Similar, right? Since the start of the game, every student-run team has sold stock or shares. What is the effect of this transaction on earnings per share? And I added this kicker because earnings per share we kind of had last time, but ROE, okay, return on equity. Yeah, return on equity. Remember, return on anything is net income divided by whatever the anything is. So in this case, it's net income divided by equity. Okay, so what impact does it have if you sell stock? You got to think that through a little bit. What happens when you sell stock? Okay, where's the money end up? How's it end up in the balance sheet and whatnot? Okay, does it affect equity? If it does, how? Okay, and then how's that affect the return on equity? Question 2. Team Andrews and Team Chester had similar total sales. If you were to look at just the selected financial statistics in the Capstone Courier, what things might tell you why Chester had a much higher profit? So selected financial statistics, and here I'm just you know, the selected financial statistics are the one that's up here, right there. Okay, right towards the top. You know, after the team names and whatnot, the selected financial statistics are here. So I'm just asking you to eyeball that. That one should be a quick one. Okay, it's one that I hit constantly, right? Boom. Okay, it's not a trick question either, so don't try to read more into it than there is there. So, oh, God, I almost gave you the answer for this one. You guys will have to do better calculations though, because I was just doing it off the top of my head. So Andrews had 1,430 units available for sale in the performance segment. What percent of the market would that have been had all the units sold? Okay, so again, I'm asking you to think about that. You guys got to remember, all of you, that I'll give you an example, or we'll go take a look here. Okay, so let's take the performance segment. Okay, the performance segment, I got to scroll way down. I'm going to go fast here. Has a total unit demand this last time of 2,700 units. Now it's a rapidly increasing, right? So it's going to add 550, you know, something like that, maybe more. So 3,200 units it's going to sell probably next round. Okay, but if I come up here to this production information, let's see, there's already 1,000 units in inventory, almost 1,200 now, 1,300. You know, about 1,400 units in total inventory. So we're going to sell 3,200, and there's 1,400 in inventory. You know, if everybody made, if all the teams together made 1,800 units, or not made them, made 1,800 units, production of 1,800 units, you know, that'd be enough to meet the demand for the next round. Okay, there's a lot here in the traditional segment, right? 1,500, 1,600, 17, 18, 2,100, you know, not quite 2,200, or I'm sorry, 29, about not 3,600 units. My math got kind of bad there. It's about 3,600 units. Now the traditional segment's quite a bit bigger, but you got to take into consideration that there's still inventory out there in those segments. You want to take a glance though and make sure, because remember we were talking about some of these from Chester, that they might be moving around a little. Now that might have been their, they've already moved. sorry, I should have saw this one already has. Coat's already moved and is being considered a traditional product. And Cure, if I remember, was about to move too. So you gotta take a peek there because they might be moving. So, all right. Well, I've given you the assignment and given you some stuff to look at, so please do it, and I'll talk to you next week. Good luck in round 3. Remember, decisions are due Sunday night, September 27th.